now to Tom Lee. He's the chief U.S. equity strategist for JPMorgan. Tom told Bloomberg last month that we've already hit our market bottom at 1250. So you're not concerned about the credit rating here. You're not concerned about fallout from Japan, about China putting on the brakes, about the European sovereign debt crisis really hitting the fan. I mean, there's a lot out there, isn't there?
Yeah, these are important reasons that logical investors are not sort of embracing this market, and I think it's healthy. I think it keeps people from getting too bullish. But the underlying driver for the equity market rally is really strong corporate profit recovery. We're seeing that with numbers this quarter, and it's relative valuation that equities offer really attractive relative value in terms of earnings yield, dividend yield relative to corporate credit, treasuries, et cetera.
I mean, Tom, it's funny because so many people come on and they say the reason we're continuing to see equities move higher in a lot of different asset classes is because there's so much liquidity out there that once the Fed stops, it's going to be a different market. I mean, do you agree, or are they just completely wrong?
Well, there's a lot of liquidity in financial markets. There's actually a lot of liquidity in consumer spending and corporate balance sheets. I mean, there is a lot of cash everywhere. And I think that's why consumer spending has actually held up surprisingly well despite $3.80 gas. And I think that's why corporate cash balances, despite record M&A, record buybacks, record distributions, are really sitting on a cash as a percentage of assets still near 50-year highs.
Tom, let me ask, you like materials, you like industrials, you like energy. I don't see tech here on the list, but it seems to be kind of the darling of fund managers right now. And of course, it's a big day for tech earnings. Why is tech not included here?
I think tech for the year makes a lot of sense. And I think because when you start thinking, 9-month, you can think of relative value. I think in the short term, we did a report last week that talked to our fundamental analysts to talk about supply chain disruptions. Technology is going to see very moderate to severe impacts from supply chain disruptions, and I think it hurts visibility. So it's a group we'd sort of want to buy on the dips, maybe more in the June timeframe.
So, I mean, we're breaking down these earnings. They're coming fast and furiously. That's more important to the market climate at this point than the debate in Washington, or you got to listen to both?
You have to listen to both. I think in the near term, earnings, especially Q1, is really going to be a support for markets. It's one reason we think you could see highs towards May, 1380 or so. And I think it's really markets get in trouble June to September. But on the debates on the downgrade side, we've been taking a very hard look at precedent examples of sovereigns getting on negative ratings watch. Interestingly, the historical record shows that 6 months out, equity markets generally do pretty well.
What do you expect here on the upside? I mean, if you think that we've already hit the bottom, where do you think we're going? And what's going to be the catalyst to drive us higher? Because it does seem like we're starting to move along sideways here. Of course, we've come so far since the bottom in 2009. Yeah.
Well, if we were to sort of do an optimal picture, we think you see 1380 by May or June. Markets sort of get range bound between June and September because of the end of QE2. But I think when you get into the fall, we're going to really look at a cumulative benefit from the recovery in labor markets. We think housing actually starts to really show significant improvement, and I think it really puts the potential for the markets to really end the year well above 1425, 1450, even higher.
Tom, are you surprised at the resiliency of the market? I just think about kind of one shock after another, whether it's, worries again about the European debt situation, the tragic situation in Japan. It just seems like, and, even continuation in rough housing numbers. Are you surprised at how strong the market is against all of that?
I think it just really shows that equity market rallies are really driven by corporate profit recoveries. And investor positioning has still been a huge preference for credit, fixed income, which offer pretty poor relative value. And I think that's what we're seeing. We're seeing investors really buy the dips here because they're underexposed.
I wonder if you just have any quick words on earnings here, Tom, as we sort of get into the meat of earnings season. What do you think of what you've seen so far, for example, the financials?
Well, I think that for financials, I think the cornerstones of a recovery in the financial sector are in place, right? We're seeing improvements in credit trends. We just haven't seen improvements in demand for credit. Both residential mortgage. I think there's still a little bit of uncertainty in terms of finalization of some of these financial reform rules.
Right.
And then I think client activity is starting to improve. Actually, I think it's improving a lot more than most people realize, because I think what's really been lacking in the market has been the sort of the downshifting of high-frequency trading.
Okay. Hey, we got to run, Tom. My apologies. We've got to cut you off there.
Right.
But thank you so much, as always. Tom Lee, he's the Chief U.S. Equity Strategist over at JPMorgan.